Hello friends, welcome to Business Learnings. This video, as the title says, we will talk about if mid-cap funds, if small cap companies, mid-cap companies, they could be the next multi-baggers or not. Uh, so typically mid-cap and first I'll tell you the the categorization of these companies. So top 100 companies in Nifty uh, in terms of market capitalization are classified as large cap 101 to 250. uh, the companies which are ranked from 101 to 250, they are classified as mid cap companies, and the companies beyond 251 and above, it probably goes up to 1000 or 1500, they are classified as small cap companies. So if you look into the performance of the index funds in the past few months, 1 2 years, about two years of history, you will see that large cap funds have performed exceedingly well, while mid cap and small cap funds, they have not performed up to par with large cap firms. In fact, their returns are sometimes negative, sometimes stagnated. Uh, Whereas if you look into the period of economic boom, like we saw from 2015 to 2018, we saw a good boom in stock market. They reached their all-time highs. They kept cracking their previous records. Um, the returns on mid cap and small caps were very good returns. Mid cap and small cap uh, firms gave back in those times. So you have to understand that mid cap and small cap, these are high beta stocks. Beta is a measure of risk. It tells you how your performance, how your company's stock returns are correlated with the returns of Nifty 50, right? So suppose Nifty 50 index goes up by 10%, your stock goes up by 15%. It means that your beta is 1.5. If Nifty goes up by 10%, your stock goes up by just 5%, means your beta is zero point 0.5, right? So this is the correlation between Nifty 50 versus your your company's stock. So the mid cap and the small cap companies, they are high beta stocks. High beta means uh, if the Nifty goes down by, if the economy goes down by some percentage, they will go down by a huge amount. And if the Nifty goes up, ideally they should go up by a good enough amount, but they do not go up because currently Nifty 50 is dominated by all those big giants which have been consistently doing well: HDFC, Kotak, Reliance Industries, etc. That's the reason mid cap and small cap are seeing a suppressed earnings, suppressed growth. But as the economy revives, we'll probably see the economy reviving in starting 3 or 4 months down the line, when all these stocks will start performing good again. Uh, we it is quite possible that we see a very good return on most of the mid cap and small cap companies. Uh, so I'll tell you a formula. You can apply it to mid cap and small cap companies, and based on that, you can shortlist these stocks, and then you can do further research to understand if you want to buy that or not. First, uh, look at the history of the company. Has the company doing consistently well in the last 10 years? Has its revenue, has its PAT been growing for quite some time? First. Second, look at the management of the company, which is very important. Third, look at the P&L as well as balance sheet, right? Uh, okay, for the second point, when I talked about the management, you have to research on the board of directors, individual members there. You have to research upon all the members of the board of directors, all the executive members, CEO, CFO, and COO, all those top notch executives. You have to Google out their names, and you'll have to check what has been their track record. If they have worked with another company, what has been their performance there, right? Because management is a very important thing. Probably because people drive businesses, right? People drive businesses, and the people sitting at the top, they have a huge say in how the company is going to perform in the coming years. So these two things that are important when you uh, look into those stocks. Next, very important thing that you never want to miss out on is the relative valuation of the company. So PE multiple, you must be aware of that, price to earnings ratio. Just look at the historical price to earnings ratio and see how has the trend been. If there is a huge deviation in the trend, the value proposition of the company is not changing. Still, if the valuation has gone down by 30, 40, 50%, you are sure that this is going to be mean reverting in the long run, and therefore you might want to add that stock to your watch list, so that you can buy probably if you think it is right. uh, Another thing that I would recommend is going through the chairman's message. Every listed company publishes its annual report, and there are two sections in the annual report which are relevant to you. First is the chairman's message, and second is management discussion and analysis. So in chairman's message, the chairman, the CEO, the MD, whoever it is, they share a vision of the company. They share what is the strategy going to be in the next 3 to 5 years, or maybe 10 years, in long term as well as in short term, and how has it been playing out, what are the challenges that they have been facing, etc. In management discussion analysis, you are going to get a good enough knowledge on the economy, the macros, as well as the company level issues and how is company going to tackle it. After you read all that, you will going to have a clear cut idea upon if the company you will have a decent idea upon whether this company is good or not. If you have decided the company is good, then look into the PE valuations and search, check how has historically their PE values have been, and if there is a huge difference, you probably might want to buy them. So thanks for watching. I hope this video was helpful. If you want to subscribe, if you do not want to miss updates, please subscribe. Thanks for watching this part. Bye.